STX is not like any other cryptocurrency. STX is way more volatile. It goes up and down, and currently it's going up quite handsomely. Plus 37% in the last week, one of the top performing cryptocurrencies in the top 100. But again, the swings are massive. When STX launched, the STX token first imploded. The drop from October of 2019 to the bottom of the Corona crash was 85%. Just to then rally again, this time by almost 5,000%. Another crash, this time 93%, and here we are today. From that bottom in December of last year to today, a rally of 260%. What do we learn from all of this? The obvious first learning is that crypto is volatile. The second learning is though that STX is way more volatile than the rest. It goes up and down way more than the rest. So timing the market with something like STX makes a lot of sense. And since those trends are so massive, why not try to catch those trends? For example, with moving averages, right? This is the 200-day. We would be long whenever the price is above. We would be short or in cash whenever it's below. That's a very straightforward trend following strategy. But the question is the 200-day really the best moving average here? Why not take the 100-day moving average or the 50-day moving average? What really is the best way to distinguish those bear markets from those bull markets? Because the shorter we go in duration, the more likely we have these fake outs, right? Where we buy high and sell low again, to buy high again, to sell low again. So very short term has these fake outs. But on the other hand, we also enter very early whenever there is a rally. We also exit whenever that rally stops, right? When the moving average is 100, we exit way later. We also have potentially less failed signals. So what's the right balance here? It's not an easy question to answer, but it is possible. We can make simulations of buying and selling the token in the past and can look at least historically, what would have been the best moving average. And we can also look at how does this compare to just buying and holding STX? Because that's in the end the most important thing, right? Does the strategy in general work, or does it only work for very few cherry-picked moving average durations? Have a look at my little Excel sheet over here that has data starting in October of 2019 all the way to today. And in this Excel sheet, we can simulate different moving average durations. And I've done this here for the simple moving average and the exponential moving average. These are daily moving averages. And we also have the buy and hold performance here, annualized 75%. But we also have different returns based on trading using those moving averages. And some of them outperform those 75% quite a bit. Yeah, look at this 44-day exponential moving average or 47-day simple moving average, quite a bit of a difference. And these are annualized returns, right? So every year compounded since beginning of that Excel spreadsheet, we made on average geometrically almost 300% with those moving averages, including trading fees. By the way, we've got 0.2% trading fees, and we bet on rising prices whenever the price is above, but we also short STX. We bet on falling prices whenever it's below. So we go in both directions here. We can display this a bit nicer here on this chart. On the x-axis, we've got the duration of the moving average. So I've backtested everything from 2-day to 200-day. On the y-axis, we've got the annualized performance. And then in turquoise are the simple moving average returns, and in red are the exponential moving average returns. So in total, we've got roughly 400 backtests here, 400 simulations of buying and selling. And what I like about this is that the strategy in general tends to outperform buying and holding, right? Buying and holding here is in black. That's the 75% per annum. And when you go above 30-day in the moving average duration, you tend to outperform buying and holding. And if you don't go too long in the duration, not above 160, you also still are in this positive area. So we can cherry pick the best moving averages here, right? We already talked about this, 44 and 47. Those are the ones we will plot on the chart in a second, but it's not even that important that we take exactly those two moving averages. In general, for STX, because it's that volatile of a cryptocurrency, following these trends tends to work pretty well here. Now let's have a look at those. So here's the price, again on a daily chart. We have to set day here, 1 day. And then we add a simple moving average, an exponential one. For the simple moving average, we set 47 days. There we go. and the exponential moving average has 44 days. This is historically what worked the best for stacks. And currently, these moving averages are obviously rising with the recent pump. The EMA is at 54 cents, the SMA is at 51 cents. So there is a bit of a risk of buying that high, right? Theoretically, we would still be bullish even after a drop of 27% roughly. So we have to go sideways for a while to take profits with a higher price than those 54 cents. But I very much like these kinds of approaches because it shows, first of all, how well does this work, but it also gives us some kind of a benchmark. 300% per annum is very nice. Who knows how well this will work in the future, but still, I rather take something specifically backtested than just randomly picking the 200 or the 100-day moving average. I personally buy not into stacks right now. I'm in general rather cautious with altcoins. I'm very heavily into Bitcoin right now because I like to ride this ETF wave. I think Bitcoin is going to outperform most other altcoins. But if you're currently in stacks and you want to find some kind of an exit or entry level, or you want to consider to short this, right? Those two moving averages might work the best. I've done a lot of those back tests. Feel free to also recommend what to do next. There is a Telegram group. Simply join us. Link is down below.